Hi everyone, welcome back. This lesson we will discuss and go over cryptocurrency to stock and traditional financial asset correlations. Here's an overview of the lesson. So we'll first start off with an introduction to what market or asset correlations are and how they are typically defined. And with that, we will observe and analyze Bitcoin's relation to traditional financial sectors, including the US dollar index, gold, the S&P 500, and more. So, correlation or asset correlation refers to how different assets perform in relation to one another over a period of time. So basically this means we want to ask, does asset 1 and asset 2 move up together? If we're comparing two assets, do they go up together? Do they go down together? Does one go up while another goes down? Do they move at different rates? These are all things we want to consider when we're talking about correlations between assets. Now typically, a correlation of 0 means that the performance of one asset is uncorrelated to the other, meaning that they have no weight on each other. Let's say if asset 1 moves up, we won't see a noticeable change in asset 2. And vice versa, if asset 1 goes down, we won't see a noticeable change on asset 2 as well. Correlation of 1 suggests that if one asset moves up, the other will move up in the same direction and also to the same degree. They're highly correlated. They're highly linked. We could think of this as maybe all assets within cryptocurrency, where they're highly correlated. And if, let's say, if Bitcoin goes up, typically we'll see other coins in cryptocurrency go up as well. So that we would say that's a higher or a high correlation. Now, a negative correlation, let's say -1, indicates that the assets move in opposite directions. So we could say, for instance, let's say if the US dollar goes up in value, we could say possibly maybe Bitcoin would go down in value, and that we would say has a negative correlation. We're going to look at several different correlations in the upcoming slides. So here's a correlation between traditional asset classes. This does not include Bitcoin, as we see here. We see several asset classes, gold, oil, both of these are commodities. The S&P 500, this is a general market index, so we're starting to see cross-sector comparisons, right? Commodities versus equities, U.S. bonds, emerging market currencies, and U.S. real estate. And this is a study by VanEck, the financial firm. This is performed from over the course of 7 years, so 2013 to just about 2020. And here we see just general correlations between these varying assets and different degrees or different severities of correlations, where we see this positive correlation indicates that there is a connection where the assets are moving in tandem, whereas the negative correlation indicates that there is a difference in market movement, where one goes up while the other is going down. Now, what's noticeable here is that generally these assets were moving at the same rate. What's interesting here is we see bonds coming down from about 2013 to about 2015, where almost arguably at the same time we start to see gold throughout 2014 going into 2015 increase in value. From 2013 to 2014, we did see bonds come down in value, whereas pretty much everything else, we see oil, U.S. real estate, the S&P 500, really everything but gold was coming up, where we do see this correlation here between the U.S. bonds and gold. At least for 2013 to 2014, we see a correlation where they're going down, whereas the rest are starting to go up. We do see a divergence, particularly here observed in 2018 through 2019, where we do see gold really begin to skyrocket in value, in contrast with, let's say, the S&P 500, which went down in correlation, and several other markets such as oil, U.S. bonds. There was somewhat of an increase we do see here, but not as severe as we saw in was with gold, and particularly from 2019 to 2020, we do see generally it was a good year in economically wise, in terms of correlation, where generally all of these markets listed were moving up in tandem with one another. And obviously we do see degrees of severity in terms of the correlation, where gold, oil, emerging market currencies, the S&P 500, the U.S. Real estate had a much more higher degree of upward correlation, positive correlation, compared to, let's say, U.S. bonds, which had a much more of a stable rate increase from 2018 going into 2020. Now here we see another correlation chart between stocks, gold, silver, and the Dow Jones. The S&P 500 and Dow Jones, I should say. This is from 2012 going into 2021. And here we see somewhat of a different picture. We get to see more of the performance of these assets, so particularly of the Dow Jones Index and the S&P 500. These funds, these indexes generally were moving in tandem with one another. Great correlation, especially seeing with these dips, particularly into 2019, 2020. Obviously, this was the severity of the COVID-19 pandemic and the absolute bottom of that pandemic-induced economic crisis observed here. We do see that having an impact on silver as well. There's a noticeable dip in silver in early 2020 at the same time lining up. Generally, though, these markets, these equity markets, were moving upwards and seeing increases generally over time, whereas silver, the commodity, has stayed rather stagnant in comparison, especially in the post 2020 post-COVID-19 economy. Now, taking a look at Bitcoin. So throughout much of its history, give or take 12 years, right? Bitcoin is a much younger asset class, much more infantile asset class compared to something like the Dow Jones Industrial Average, or even the stock market, which has really been around for over 150 years, almost 200 years, give or take, depending on what you're looking at. So turning back to Bitcoin, so the infantile Bitcoin really has only been around for about 12 years, give or take. Throughout much of its history, Bitcoin has retained a much lower correlation to traditional asset classes such as equities, bonds, and commodities such as oil or gold. Really, this has only started to change in the past 2 years or so, give or take, or arguably maybe even the past 5 years. But once again, throughout much of its history, Bitcoin has retained this lower correlation. Now, this historical uniqueness to Bitcoin's price patterns have made it an attractive tool for portfolio diversification for traditional investors, where these investors could see the new digital asset being used as a hedge against the many factors affecting the traditional market, whether that's inflation, war, times of crisis, political unrest. These all are factors that can and have affected traditional financial markets, and some were seeing Bitcoin, this new asset class, such as cryptocurrency, as something that could potentially be used as a hedge against those many factors, where maybe the severity would not be as strong. Now, however, for most of Bitcoin's existence, it's only existed during times of economic prosperity in a global macro scale, so it remains untested in a true financial downturn. Once again, the last global financial crisis that was observed was around 2007, 2008, with the housing market crash and a general global recession in the years to come. Bitcoin really was only created and came out of that crisis as an answer to that crisis, something that could not be controlled by banks or governments, and it hasn't been tested in a true financial downturn. And this is something that we will have to see if Bitcoin retains value over time. Now, here's a study from the VanEck financial firm. Greater correlations. This is a general correlation listing from February 2012 to about March 27th, 2020. So around this time, the COVID-19 pandemic, the effects of the pandemic and economic closures, we were starting to come to fruition. So this really just highlights this general period from the post financial crisis of 2008. We could say that at this point there was a general market recovery from 2012, from that time period, and moving onwards to 2020. So this 8 years of economic growth following that downturn up until, we could say, arguably the COVID-19 downturn. So this is taking a look at the S&P 500, the NASDAQ 100 composite, U.S. bonds performance, Bitcoin, which we do see here. At this point, from 2012 to about 2020, Bitcoin is still relatively unknown to the masses. It really only came into the spotlight, arguably, in 2017. Where in 2017 we saw a rather large market cycle and really attracted a lot of headlines and news. A lot of eyes were turned towards Bitcoin and questioning whether or not this new internet money could truly hold value and was worthwhile as an investment. We also see gold here, U.S. real estate, oil, and emerging market currencies. So taking a look here, we do see generally the strongest correlations are observed between the NASDAQ and the S&P 500, which is really not a surprise considering that they're both equity indexes. They're both funds that track a collection of stocks. So it's not a surprise to see a great correlation, a 0.96, almost a 1-to-1 correlation between these two indexes. Looking elsewhere, so let's stay focused on the S&P 500 for now. We see a extremely lower correlation between the S&P 500 and U.S. bonds, a negative 0.26 correlation, where if the S&P 500 is going up, we do see a negative correlation here where bonds will be going down, and vice versa. If bonds are increasing in value, the S&P 500 will be going down in value. A 0.01 correlation between S&P 500 and Bitcoin during this 8-year period, which is generally interesting because one would think that they would be more highly correlated, which is more true to the more current day of 2022, where they are increasingly much more highly correlated. We'll take a look at studies of that in a little bit. Looking forward, the S&P 500 and gold is zero correlation, so there's no noticeable correlation between them. A 0.72 correlation between the S&P 500 and U.S. real estate. So these can be arguably said they are highly correlated. Maybe not as strongly as the NASDAQ with the 0.96 correlation factor. And then also looking at oil, 0.36, and emerging market currencies 0.3. So these are both positively correlated. They both will move in tandem, but at different rates, right? So the Nasdaq will move at a greater rate along with the S&P 500 compared to the US real estate market, which will then move at an even greater rate compared to oil and emerging market currencies. Now, we use the S&P 500 as our example. Taking a look at specifically Bitcoin, generally for this 8-year period, overall we see fairly low correlations, especially in contrast with, in comparison with the other categories that we have listed here. Bitcoin with the S&P 500, a 0.01 correlation, with the Nasdaq 0.00, so ultimately no correlation found. 0.03 correlation with the U.S. bond market during this time period, with gold 0.03, U.S. real estate 0.03, and oil a negative 0.04, and emerging market currencies 0.01. So generally overall, not a lot of market correlation at this particular period. Bitcoin was moving on its own, really working within its own cycles, and was arguably in its infantile stages. It still was maturing as an asset class. Even in 2022, it's still maturing as an asset class, but in comparison to what it is now, to what it was then from 2012 to up to 2020, it was significantly lower in market capitalization and overall much lower amounts of people overall interested in Bitcoin and then in crypto overall, right? We didn't have the headlines, we didn't have the great amounts of retail and institutional interest in cryptocurrency as we do see today. Now, turning towards 2020 and beyond, the economic crisis that unfolded from the COVID-19 pandemic in 2020 provided extreme opportunities in crypto markets, especially for Bitcoin. It was a extreme buying opportunity, and arguably once in a generation moment to build wealth. So the price of Bitcoin during this time, it reached new all-time highs in 2020. It closed out 2020 at an all-time high of 29,000, and arguably it started off the year in March around 4,000, give or take on what exchange and when you were looking at it, and to increase to an all-time high of 29,000 is a considerable return on investment within a less than a year time period. Now, during this year, analysts observed increasing positive correlations between Bitcoin price action to traditional asset classes, where cryptocurrency and traditional financial sectors would move in tandem with one another more frequently. This was a noticeable thing. We're starting to see similar patterns, similar correlations between Bitcoin and traditional asset classes such as the S&P 500. Now, arguably this could be said due to increasing overlap of crypto and traditional finance investors in the 2020 cycle. In 2020, 2021, 2022, we're starting to see banks, hedge funds, overall financial firms, the greater increase and inclusion of exchange traded products, including ETFs on various major exchanges, such as in Brazil and in Canada. So all of these factors, we're starting to see the same people who would previously invest in the S&P, previously invest in the Nasdaq, they're starting to take their capital and invest it into crypto, which was not something that was previously done as much prior to 2020.